Is Philip Cormie. Now, Philip is an expert in his field. He's from Mosaic Advisory and Capital, and he's here today to talk to us about models to evaluate investment impact. So, welcome to the stage, Philip. He might even be giving us some extra hints around getting rid of some more of those myths around finance and investing. Or I could play you my Mythbusters theme song again. Or maybe not, as the case may be.
Okay, are we right to go?
And he's coming online, and there he is. He's looking awesome and ready to speak.
Right. It's very kind of you. So, look, I'm not going to follow the presentation closely because a number of the points I wanted to make have already been made. What I do want to say is that the approach we use is research and application based, and the principal question that we were trying to answer when we started this process some years ago was, what is it that impedes flows of funds from major asset portfolios in financial institutions into addressing areas of concern such as UN development goals? Now, it's already been mentioned that that the scale of the opportunity, which is the way we would look at it, is huge. You know, that there's 3 trillion plus for 20 years required, 3 trillion per annum for the next 20 years required to address those goals. So that was one dimension that we were interested in. The other dimension, looking at it from a financial industry point of view, is that the major funds, such as in life and pensions and general insurance, are showing unsustainably low returns. And when I say unsustainable, they're so low as for them to be unable to meet their fiduciary responsibilities going forward. So we commissioned a study. At the time I was working for Zurich Insurance in Switzerland. We commissioned a study, participated in it as well at Cambridge University, and that showed that uniformly across all geographies, that finding was validated. So, but in those funds, there's north of $43 trillion, and the returns are very low, arguably in real risk-adjusted terms negative, because all the asset classes are at least fully valued. So there's no shortage of demand, and there's really no shortage of supply. There's what the barrier was is how to unlock those flows. And the approach, which the shorthand term we use is FRS, which stands for Finance, Risk and Social Returns, bridges, if you like, or deals with those impediments to flows. It also deals with, shall we say, ideological gaps. In many of the conferences that you go to around the planet on things like impact investing, you find discussions going on with people who are very committed to change, and at the other end of the room, there are people from financial services who are where the language is just not the same. The one memorable event on my part was I attended a conference. There were 1,000 participants, 6 big workshops of a couple of hundred people. One of those workshops was about unlocking the funds flow from big financial institutions. There were 6 financial institutions represented, and of those 6 workshops, there were only about 20 people who attended that conference. So FRS is a solution to this problem. We take the view that investment is investment. You don't have to call it impact investment or investment for climate or anything else. You simply need to focus on the criteria and how to make those work. There's no need for trade-offs. What we've just found in our work is that you can achieve through the same mechanisms strong returns to community, government and to investors. So one example that I would quote is the one relating to an Indigenous community. On a $50 million spend, there's about a return of, say, circa 15% to financial, but this also of the order of 80% return to community per annum and 50% return to government. So so there's no need for us to, in generally, to create this this discussion of trade-offs. So what we focus on is, of course, the outcomes. That is the outcome, let's say, of a community or a subject area. But what we're interested in is the underlying drivers of those outcomes and the investments that are necessary to make those a reality. As someone else said a moment ago, it's also important to understand that that there are high interdependencies. So it's rarely possible to deal with a single intervention in isolation. So a portfolio approach is necessary, but it needs to be a harmonised portfolio. So there's, and one last point, that we generally find scale is of limited value. Replication as a means of achieving scale is frequently the best approach, which means that you will find the lowest, smallest, economically replicable entity, model it, and then use it over and over again to deal with a particular issue. So in an Indigenous community, for example, it might be $50 million to fix one, to assist a community to deal with their local economic and social issues. That can be created into a portfolio of, say, 500 million, but it's not a scale. It's not just it's replication, not just increasing scale. So I think in terms of the impacts that we achieve, in the pack you will see that there are diagrams there that deal with returns on social return on government investment, financial returns on private funding, the nature of the interventions, and the key point is that all those things need to occur in harmony. You can't just cherry pick because it just doesn't work. So I won't labour these points any further. You can look through the pack. What we're looking for, frankly, is people and organisations who want to make a difference, whether they are people who need advice and money, or whether they're people who are wanting to invest. So if there are any further questions, I'm happy to pick them up offline. Thank you.